Let us start. Welcome students, welcome to lecture number 37 where we will be continuing module number 5 and the subject financial management. So as we know, module number 5 is working capital management, which consists of theory part as well as problems. So in theory, we have already covered in respect of working capital under lecture number 34. Problems, we have seen how to determine the operating cycle, how to determine the cash cycle, how to estimate the working capital requirement, and we have seen some sums or case studies as to how it will come on working capital determination. Today, we will be continuing with the same thing, continuation on estimation of working capital requirement of firm, continuation on case study on working capital determination, and we will also start module number 6 with the introduction part. So a quick revision of what we have done in a previous lecture. How do we determine working capital? Working capital is nothing but the current assets minus the current liabilities. You get the amount of working capital required by the firm. Now you need to know what all falls under current assets. So we know that stock, debtors, cash in hand, cash at bank, prepaid expenses, account receivables, bills receivables, all falls under current assets. Current liabilities are liabilities that has to be paid off within a period of 1 year. Now, what all falls under current liabilities is your creditors, bills payable, outstanding expenses, short-term loan, short-term provisions. So once you are able to bifurcate or separate what falls under current assets and current liabilities, just minus the both, then you will get the working capital. Now, for exam point of perspective, how are you supposed to present your answer? So you can present it in this format, that is estimation of working capital requirement of a firm. Make 2 columns, particulars, rupees. At the first, you have to start with the current assets, list down all the current assets, take the total of current assets as A. Then write the current liabilities, list down all the current liabilities that are given in the problem. Take the total of current liabilities and name it as B. So working capital is nothing but your A minus B. To that you add certain provisions or margin for contingencies, you get a net working capital required. So this is a format which you have to prepare when you all are doing, when you are asked to determine the working capital requirement of a firm. Now, before solving the problems, what are the important points that we have to consider? Like I've already explained this in my previous lecture, but doing a quick revision of it. So while calculating amount of work in progress, always take the overheads and labor at 50% completion unless specifically mentioned in problem. So unless they're mentioning some other percentage in the problem, take that percentage. If nothing is mentioned, always take at 50% completion. Depreciation amount should not be included, means in the overhead amount, you have to always exclude the depreciation. Finished goods and debtors are to be taken at cost and not at selling price, and cost should be excluding depreciation. And what is the amount payable to creditors? It will be the same amount as the cost of raw material. Profit should be completely ignored while calculating working capital, and stock and debtor should be taken at cost. Next, we had solved 3 problems on working capital. Today we will solve the remaining. So is this Word document clear, visible to everyone? Yes, students? Is this Word document visible to everyone?
Yes, ma'am.
Okay. So yesterday we had completed 3 problems. Now the fourth problem. The fourth problem is from question paper 2017, and it is same as the same question which appeared in the question paper in the year 2014, which is already solved. So this problem, what we are going to do, that is 2014. This is the same problem which had come in 2017. This is the same problem, students. This is already solved. Okay. So I just want you all to take a snapshot of this and solve this problem at home. So everyone, since it is the same problem that we have already solved, I will not be solving it again and not be explaining since it has already been explained. But I was covering the previous year's question paper. That is why I've taken this particular type of problem again. So can you everyone take a snapshot of this and solve this for your classwork? Yes, students, it is similar to problem number 1 that we have solved. It's the same problem. So I request everyone to take a snapshot of this. Once you are done, let me know. I'll move ahead with the next problem. Yes, students, done? Done, students? Students, have you all taken a
Yes,
snapshot
ma'am.
of it? This problem is for your classwork. Okay. Now let us move ahead to problem number 5. This problem is from the question paper 2018. Okay. So let us solve this problem. On 1st January 2017, the BOD of Yadu Yaran Company Limited wishes to know the amount of working capital that will be required to meet the program activity that they have planned for the year. The following is the information available. Okay. Issue and paid up capital is rupees 2 lakh. 5% debentures is rupees 50,000. Fixed asset values are 1,25,000 on 31st 12 2017. Production during the previous year is 60,000 units, and it is planned that the level of activity should also maintain in the current year. So current year also the production will be for 60,000 units. The ratio of cost to selling price is raw materials is 60%, direct wages 10%, and overheads 20%. Raw materials are expected to remain in the States for an average of 2 months before these are issued for production. Each unit of production is expected to be in process for 1 month and is assumed to be consisting of 100% raw material, okay, and also include direct wages and overheads. Fixed assets, finished goods will stay in warehouse for approximately 3 months. Creditors allow credit for 2 months from the date of delivery of raw materials. Credit allowed for debtors is 3 months from the date of dispatch. Selling price per unit is rupees 5. There is a regular production and sales cycle. Prepare schedule of working capital and balance sheet. So students, we know that the formula for working capital is current assets minus current liabilities. So from this particular problem, we have to first pick up the current assets. Now we know under current assets there is stock coming, and since it is a manufacturing unit, as we know there is finished goods separately given, there is raw material separately given. So what we have to do is we have to first take the inventory in which we will have raw material separately, finished goods and work in progress. Next we know debtors. Here it is given credit allowed for debtors. So next uh, current asset that we need to take is debtors. Now, issued and paid up capital is not your current asset. It comes under your liability side. Debenture is not, it comes under your liability side. Debentures are not your current assets or current liabilities. It comes under long-term liabilities. So again, it comes in your capital, that is in your balance sheet. Fixed asset also will not come under the working capital calculation, because we under working capital calculation we only take current assets. So your working capital calculation will start from point number D. So whatever information you require for working capital, you have to ignore point number A, B, C, because they are not falling under the head of current assets and current liabilities. You have to first identify what falls under current asset and current liability. So whatever information we require, it is falling under from point number D to point number K. So now let us start. See students, we know that current assets first thing that comes is raw materials. Now raw material, we know that the number of units are 60,000 units. We know that the raw materials are expected to remain in states for an average of 2 months. So the number average period is 2 months. Now let us see what is the cost of raw material. So here they have told that the ratio of cost to selling price for raw material is 60%. And what is the selling price? 5. So what is the raw material cost, students? It is 60% of 5, because see, the ratio of cost to selling price for raw material is 60%. So if the selling price here is rupees 5, then what will be the cost of raw material? 60% of the selling price. That is 3 will be the cost of raw material. What is the cost of direct wages? 10% of selling price. Now what is selling price? 5. So what is the cost of direct wages? It will be 5 into 10%, which is 0.5. Now overhead is 20% of selling price. Selling price is given as rupees 5. So 5 into 20%, that is 1. 1 will be the cost of overheads. So individually we have known what's the cost, correct? Then we got the raw material cost as rupees 3. So it is again the same thing that we have repeated in all the sums. Take rupees 3 as the cost of raw material per unit into 60,000 into 2 divided by 12. By 12 because here it is given, average period is given in number of number of months. So we are dividing it by 12. So let us see the working. Calculation of working capital requirement. First you take current assets. In that we have taken raw material. Okay, we have taken raw material and the working we have shown it as 3 into 60,000 into 2 by 12. Now how we got this 3? We'll see the working note. See here students. Calculation of cost of finished goods and debtors. We know that finished goods and debtors are always shown at cost. Here cost is not given. Here ratio of cost to selling price is given. So the selling price is rupees 5. So raw material is 60% of the selling price. So 60% into 5 we got 3. Then direct wages is 10% of the selling price, that is 5 into 10%, that is 0.5. And overheads is 20% of selling price, which is 5 into 20%, that is 1. So your total cost comes up to 4.5 and your selling price is 5. So is this note clear to everyone? Yes, students? Yes. Is this clear
Yes,
to
ma'am.
everyone? Okay. Now we finished with raw materials. What is the next thing that we are going to take in current assets, students? We have finished with the raw material calculation. After raw material, what is the next thing that we have to take under current assets? Yes? Yes, students, what is the next thing that you're going to take under current assets? After raw material, what do we have? We have work in progress, we have finished
Work in
goods.
progress.
Right? Work in progress. Now in work in progress, you have 3 elements again. Work in progress will consist of raw materials, your direct wages and overheads. So can anyone tell me what is the cost of raw material? Are you going to take completely 3 or we are going to take 50% of 3? For raw material, under work in progress, what is the cost are you going to take? 3 or 50% of 3? Quick students, we have done it in our
50%.
for raw material. See, under work in progress, you have 3 elements: raw material, direct wages, overheads. Is raw material to be taken at 100% or 50%?
100%.
Very good. And your direct wages and overheads under work in progress is to be taken at complete 100% of whatever cost is given or only 50% of the cost? Yes, students? It is to be given at full 100% or 50% only?
50%.
Very good. So see here, direct wages is the cost is 0.5, but completely 0.5 you cannot take. So for WIP work number note number 2, direct wages will be 50% of 0.5, that is 0.25, and overheads will be 50% of 1, that is 0.5. So see here, raw material calculation we have seen. Work in progress, 3 elements will fall under work in progress, that is raw material, direct labor and overheads. Raw material you're going to take at complete 100%. So 3 into 60,000. 60,000 is the units of production, and this is 3 is per unit cost into 1 by 12, because here they have told work in progress period is for 1 month. See here, each unit of production is expected to be in process. So that means in processes, that is work in progress. So that is for 1 month. Okay. So you're going to take 1 by 12. Now, direct labor, you're not going to take the complete amount. You're going to take 50% of direct labor amount. So it is 0.25 into 60,000 divided into 1 by 12. And overheads is 0.50 into 60,000 into 1 by 12. So you have got the amount of work in progress. Now, can anyone tell me at what cost will I take finished goods? Now, based on this working note, can anyone tell me, should I take the cost of finished goods at 4.5 or rupees 5? At what price should I take the value of finished goods for the purpose of calculation of working capital? Yes, students? Quick, students. For finished goods, what value should I take? Yes? Yes, students? For finished goods, what value am I supposed to take? Should I take the selling price or should I take the cost price? Yes, students?
Cost price, ma'am.
Very good. So I take 4.5. So here, finished goods, I take it at 4.5 into 60,000, because 60,000 is the units of production and finished goods are in warehouse for 3 months. So into 3 divided by 12, you get 67,500. Similarly, debtors are also to be taken at cost. So 4.5 into 60,000, which is the units of production. And here in the information, it is given that credit allowed for debtors is 3 months. So into 3 by 12. So you get 67,500. Now you got your total current assets. Now your current liabilities, you have only creditors. Now, students, what is the price at which I have to value the creditors? At what value should I take the creditors? Yes, students? Your creditors period allowed is 2 months, we know. But at what price should I, or what cost should I take the value of creditors? Can anyone tell me? Based on this working, can anyone tell me out of all this values, cost, what should I take the cost of creditors as? Yes, students? Yes? Can anyone tell me? Here I have shown you all, right? The amount payable to creditors will be the cost of raw materials. So now can anyone tell me at what amount should I take the creditors? Yes? Yes,
Raw
students?
material.
So what is the amount of raw material here?
3.
3. So 3 into 60,000, because 60,000 is the units of production, into 2 by 12, because here it is given that the credit allowed to the creditors is 2 months. So 2 into divided by 12. So you got 30,000. And there is no delay in payment. There is no outstanding expenses given in the problem. There is no lag in the payment given in the problem. So only creditors 1 is the correct liabilities. So you minus the current assets with the current liabilities, you get the net working capital as 1,53,750. Here in the problem, they have also not mentioned that please keep certain provision aside for contingencies. That is why we have not added the contingencies. If they specifically given the problem that keep 10% as contingency margin or keep 5%, then only you need to show it. Here, since the problem is not mentioning anything about it, then do not show. Next, we have finished. They have asked you two questions. One is prepare the working capital schedule, which we have prepared. Second, they're asking prepare balance sheet. Now we know, students, in balance sheet we have one liability side and asset side. Under liabilities we have long-term liabilities and current liabilities. Under assets we have fixed assets and current assets. So we know that these issue and paid up capital, it will come under liability side. Debentures we have to show under liability side. Fixed assets we have to show under asset side. And current assets and liabilities, whatever we have to calculate, we have calculated, we have to show in the respective sides. So let us prepare balance sheet accordingly. So students, this is the projected balance sheet. Share capital, as it is we have written from the uh, as it is we have written from the uh, sum problem 2 lakh rupees. 5% debentures, as it is we have taken from the problem 50,000. Creditors we have calculated, students. Creditors we have calculated 30,000 and we have written 30,000 as it is the value of creditors. Okay. Next, what we have to do is we have to we are writing fixed assets, which is directly given 1,25,000 in the problem. Now, whatever current assets we have calculated, that is, first we have calculated is the raw materials. Okay, raw material is 30,000. So we have directly written here raw material cost as 30,000. Okay, work in progress, we have already seen it is 18,750. We have written 18,750. Finished goods is 67,500. We have written 67,500. Now, students, your working capital calculation, your debtors are taken at cost price. Correct. We are taking debtors and finished goods for the purpose of working capital calculation at cost. But in balance sheet, debtors will always come at selling price, because you do not sell the goods to the customers at cost price. You're selling the goods to the customers by adding a profit margin where you derive your selling price. So all, and from debtors you have to receive the selling price amount, not the cost price. Including profit you're going to recover from the debtors, right? So that is why debtors are to be shown at selling price. So what value you have to take for the debtors is 5 into 60,000 into 3 by 12. So whenever you're showing it in balance sheet, you're going to take debtors at selling price. The selling price is 5. So you're going to take 5 into, instead of 4.5, you're just going to keep 5 into 60,000 into 3 divided by 12. You get 75,000. So this is how you are going to calculate the debtors at selling price. Now, can anyone tell me, the selling price is 5 and the cost is 4.5. So what is the profit made by the company? Yes, students, what is the profit made by the company? Yes? Can anyone tell me what is the profit made by the company? Yes, students?
Point 5.
Students, if the selling price is 5 and the total cost is 4.5, what is this profit made by the company?
0.5.
0.5. And what is the total profit made by the company? See, production units are 60,000. Per unit profit is, means behind every unit the profit is 0.5. So if the total production units is 60,000, so what is the total profit made by the company? 60,000 into 0.5, so it is 30,000. So see here, under reserves and surplus, profit for the current year is 30,000. So we have written down all the figures in the balance sheet. Take the total of the asset side, that is 3,16,250. The same total you have to take it in the liability side, because you know assets and liabilities have to be equal. The total should be the same. That is why it is called balance sheet. Now, whatever is the difference, that you have to write it as a balancing figure, that is profit and loss. Balancing figure you have to write 6,250. This is your balancing figure. This is the complete solving of this particular sum. Is this clear to everyone? Is this problem clear to everyone? Yes, students? Yes? Is this problem clear? See, for working capital calculation, debtors has to be taken at cost, but when you're preparing balance sheet, debtors has to be taken at selling price. The second thing, for working capital calculation, you never consider profits. But obviously, you know that in balance sheet, the current year profit has been transferred. Therefore, in balance sheet, the profit figure is going to come. Is this problem number 5 clear to everyone, which had appeared in question paper 2018? Is it clear? Yes? Yes,
Yes, ma'am.
students? Okay. So we have completed module number 5. Now we begin with module number 6. So these were all the sums that in respect of estimation or determination of working capital requirement which we have seen, which we have solved relating to all the previous year's question papers. So now you'll know what type of sum usually falls or will fall in the question paper. Now we begin with module number 6. This is our last module under subject financial management. Now, module number 6 is nothing but capital structure and dividend decisions. Okay. Now, as per with your syllabus, it covers, you can see on the left hand side, capital structure and dividend decisions. This and the left hand side is complete theory. On the right hand side is a combination of theory as well as problems. So theory, what we have to cover is planning the capital structure, leverages, EBIT and EPS analysis, ROI and ROE analysis, capital structure policy, dividend policy, that is no dividend theories to be covered, factors affecting the dividend policies, stable dividend, stable payout. And under determination and estimation of theory and which is a combination of theory and problems, we have to see how to determine and estimate the leverages, how to do the analysis for EBIT and EPS analysis, and we have to see case study on EBIT and EPS analysis and leverages. So this is a complete thing that we have to cover under module number 6. So today what we will be seeing is the theory part, this complete theory part relating to module number 6. That is the complete left hand side we will try to cover in today's lecture. So let us begin. First is planning the capital structure. Let us understand what is the meaning of planning of capital structure. Students, what is the meaning of capital? See students, funds is required by the company, correct? Now, the company raises the funds through different sources of finance, which we have already seen, like through equity, through preference, through issuing debentures, through taking a term loan, the company can raise its capital. Now, whatever combination the company is going to select, like it can either select preference and debentures to raise funds, it can either select a combination of term loans and equity. So, whatever structure the company or whatever combination the company is going to select in raising its capital or raising its funds is called capital structure. Means in what structure or what combination or what mix it is going to do in order to raise its capital is called capital structure. Now, to build up its capital structure, it has to do planning, right? It has to plan that what mix should I take? Should I take equity debentures? Should I take equity preference debentures? Should I raise the finance with preference and debentures? Should it raise the finance with only debentures and term loans? So what a planning has to be done by every business unit or every company has to plan. Correct. It just cannot randomly pick any combination and raise its finance. So planning is required. So that planning is called planning of the capital structure. But the planning should be done in such a way, students, that it should aim at maximizing the profits. So obviously your plan should always aim that the profit should increase, the wealth of the shareholders should increase, the value of the firm should increase. So while planning, whenever any finance manager usually plans this, okay, or the management of the company when it is planning the capital structure, it should plan in such a way that with the and with such a combination of the sources of finance that the value of the firm should increase, number one, the wealth of the shareholder should increase, number two, the profits of the firm should increase, number three. So when all this is gained, then that plan for raising the capital structure should be selected. So let me read out this particular slide. Capital structure planning aims at maximization of profits and wealth of the shareholders and ensures the maximum value of the firm in the market. Planning the proper mix of debt and equity means planning the correct best mix or best combination of debt and equity in the capital structure in order to achieve the optimal capital structure. Means planning should be done in such a way that a best capital structure should be selected which is going to increase the wealth of the firm. A firm should try to reach as near as possible of the optimum point of the debt equity mix. So optimum point is going to be the best point. It is going to be that point where the value of the firm is increasing, wealth of the shareholders is increasing, profits of the firm is increasing. In order to plan optimal capital structure, the below analysis can be used. See students, every company which wants to plan its capital structure, it cannot just plan based on its judgment, prediction, correct? It has to do certain study. Before making a plan, it has to do certain study. On what basis it will do the study? So it has to do analysis. Now, with the help of EBIT, EPS analysis, it can plan cost of capital analysis, it can plan cash flow analysis and leverage analysis. So these are nothing but tools which are going to help the company to plan its capital structure in such a way which is going to ensure that it is going to increase the value of the firm and it is going to be the best capital structure. So these analysis are nothing but tools which are going to help the company in making the proper planning of capital structure. Means making a proper planning in such a way that the best combination of sources of finance is being selected, which will ensure that maximum value of the firm is being achieved. Is the planning of capital structure meaning clear to everyone? Yes, students? Yes? Did everyone understand
Yes, ma'am.
what is the next? First, now see here, we have to see four types of analysis. So first analysis is EBIT and EPS analysis. Now under this, what happens, students? EBIT is nothing but earnings before interest and tax, and EPS is earnings per share. So and EBIT is how do you analyze by using this tool? How do you analyze the best capital mix is? What do you do under this particular analysis is you will have the EBIT, that is earnings before interest and tax. So when the earnings before interest and tax is given, what will be your EPS for different combination of sources of finance? See students, at a given level of EBIT, obviously the EPS will be different. EPS is earnings per share. It will be different under different financing mix. When I say financing mix means combination of debt and equity. So when you keep on changing the combinations, your EBIT will change. Accordingly, your EPS will be changing. So you have to keep changing the EBIT and EPS depending upon different financial mix. And after doing a trial and error of different financing mix, wherever your EPS is highest, you are going to select that particular combination or that particular mix while creating the capital structure. So, see students, it gives a comparative study of various choices available under hypothetical figures of variable EBIT and EPS. So, what does it mean? You change the EBIT and EPS, keep changing depending upon your financial mix. Like either you want debt and equity, either you want preference and equity, either you want term loan and debt. So, you keep changing it. So, depending upon the change, you see, calculate your EPS. Wherever the EPS is maximum, that should be selected. So the result in maximization of EPS, that particular capital structure should be selected. Now see students, earnings before interest and tax. Now what is this interest? This interest is the fixed interest. Fixed interest is on the financial charge, that is interest on debentures, correct? Or interest on term loans. It will be fixed. So you keep on changing the EBIT. Okay, suppose if you want to take debentures and preference, you know that both debentures and preference have fixed cost involved, because in case of preference you have fixed dividend, in case of debentures you have fixed rate of interest, correct? So you keep on changing the financial mix, keep on calculating the EPS. Wherever the EPS is highest, you select that particular capital structure. So here what they're telling, figures of variable EBIT and EPS keep on changing depending upon your financing mix, and then you analyze where the EPS is highest and select that particular EPS. Next, cost of capital analysis. See students, every rupee invested in a firm has a cost, that we know, because see, through whatever sources of finance we are raising the funds, every source has some cost involved in it. You do not get anything free of cost, correct? Now, cost of capital refers to the minimum return expected by its suppliers or investors. Correct. So whatever capital is invested either by maybe the shareholders or maybe the investors, you have to give some return to them. The capital structure should provide for minimum cost of capital. The main sources of finance for a firm are equity, preference, and debt capital. The return expected by suppliers of capital depend upon the risk that they undertake. Usually, debt is a cheaper source of finance compared to preference and equity capital. So, students, under cost of capital analysis, what you have to do is you have different sources of finance. What you have to see, suppose if you want to raise or planning to raise the source of finance through debentures, you have to calculate what is the cost associated with debentures. With equity, what is the cost associated with equity, and with preference, what is the cost associated with preference. So under cost of capital analysis, you will select that particular mix or that particular combination of debt and equity where the cost of capital is going to be less and not high. In case of EBIT and EPS analysis, you're going to select that particular combination where the earnings is more. But in cost of capital analysis, you're going to select that particular combination where your cost is less in respect of raising that particular source of finance. Next, cash flow analysis. So at the time of planning the capital structure, the ratio of net cash inflows to fixed charge should be examined. The ratio depicts the number of times the fixed charges commitments are covered by the net cash inflows. See students, what is fixed charges commitments? So like in case of debentures, interest you have to pay, that is fixed, you have to pay the interest, it is not variable. Like dividend to equity shareholders is variable, but interest to debenture holders is fixed. Dividend to preference shareholders is fixed. Interest on term loans is fixed. So you have to make sure that you are able to pay off the fixed commitment charges based on your cash inflows. So the ratio depicts the number of times the fixed charge commitments are covered by the net cash inflows. When you know these are fixed charges which you have to pay, so you have to make sure that your inflows are more than your fixed charges commitment. Greater is this coverage, greater is the capacity of the firm to use debts and other sources of funds carrying fixed rate of interest and dividend. See, students, once you know that your inflow is more, then you can select those sources of financing which has fixed charges. Like if you know your inflows are is sufficient, then and you know with that inflows you can pay off your fixed dividend on preference shares, or fixed interest on to debenture holders, or fixed interest on your term loans, then only you can go for that particular source of finance for raising your funds. Otherwise you have to select some other combination. So in cash flow analysis, the liquidity side of the leverage is stressed. So, what is liquidity? Students, liquidity is how fast the company can convert its current assets into cash. How quick the company can, get the cash easily, or how liquid the company, how quickly it can convert its assets into cash. So, in cash flow analysis, you will know if the liquidity is more, then you can select for those particular combination where the charges are fixed. Next, leverage analysis. So in business, leverage emerges out of fixed cost. Now, can anyone tell me what are the fixed cost? Till now, I've repeated what are the fixed expenses or fixed cost. So can anyone tell me what are the fixed cost? See students, till now I have
Interest.
repeated what are the fixed cost? Yes,
Interest.
very good. Next. Next, what is the fixed cost? After interest, there is dividend to preference shareholders is also fixed. So, it is an employment of fixed assets or funds for which a firm has to meet the fixed
Ma'am,
cost or fixed rate of interest obligation, irrespective of the level of activities attained or level of operating profits earned. See, what do you mean by this, students? Irrespective of your sales. Suppose your sales in this month is zero. If it is zero also, you have to pay your fixed cost. You have to pay interest to debenture holders, you have to pay interest to term loans, you have to pay your interest, dividend on to preference shareholders. So irrespective of the level of activity attained, whether you are making sales or not making sales, whether you're making profit not making profit, that is irrespective, students, you have to make sure that you meet your fixed cost. So leverage analysis, what happens is it is your irrespect, you have to first ascertain your fixed cost. Okay, whether you will be able to meet the fixed cost irrespective of whatever situation happens, whatever sales happen, are you able to meet your fixed costs? Because leverage will have different degrees. Suppose the degree of leverage is high, leverage is nothing but a risk. So if the degree of leverage is high, so that is, suppose the higher is the risk involved in meeting the fixed cost obligations that we have seen. That is maybe the operating fixed cost, or it can be the fixed cost relating to sources of finance. Okay, so the risk will be higher. Higher the leverage, higher will be the risk in paying off the fixed cost obligation. So by finding out the leverages, you have three types of leverages: operating, financial, combined, and composite leverages. And you usually calculate this in percentage. So if the degree is very high, then there will be high risk in meeting the obligations, fixed cost obligation. So accordingly, you have to take call whether you have to, uh, prepare or plan your capital structure in such a way where the fixed cost, wherever the fixed cost is involved, whether that combination you have to select it, you have to just ignore those and select those where variable, that is you are going for equity capital. Next, ROE and ROI analysis. So ROE is return on equity and ROI is return on investment. So return on investment means what, students? Once you have invested, what is the profit you're getting on your investments? So what is return is nothing but your income on investment, what you're going to get. Okay, and return on equity is whatever capital you have raised, what is the return on equity that you're getting. These both are the measures of performance and profitability. So the higher ROI and ROE is better. So you calculate ROI, like whatever investments is there, with the cash inflows that you're getting return, you take what is the ROI calculation, you take what is the ROE calculation, and you check if both are higher, then it is better, then you can go in for that combination where you're getting higher ROI and higher ROE. Okay, ROI is nothing but, students, it is whatever profit you're getting from your investment, okay, minus the cost of investment. See, return is nothing but whatever is the cost minus whatever profit you have got divided by the again cost. You will get exactly return on investment in terms of percentage. So if your profit income what you're getting minus cost is nothing but the net return that you're getting from investment, if that is high, then go in for that particular combination of capital structure. So ROE is also a simple equation that calculates how much profit a company can generate based on invested money. The basic formula is net income divided by shareholders' equity. So ROE is nothing but net income divided by shareholders' equity. If ROE is higher, please go in for that particular capital structure and combination of that particular financing mix. Next, dividend policy. Now let us know what is the meaning of dividend policy. Dividend policy is a policy a company uses to structure its dividend payout to the shareholders. Students, what is dividend payout? Dividend payout is nothing but dividend payment to the shareholders. That is, it can be fixed dividend payment to the preference shareholders, variable dividend payment to the equity shareholders. Dividend payment can be done monthly or half yearly. Half yearly is called interim dividend between two AGM, or it can be annual dividend. So when should a company pay dividend, at what rate should the company pay the dividend, okay, all these has to be planned, documented by the company, right? All this has to be structured by the company has to take a decision as to when the dividend has to be paid, at what percentage it has to be paid, okay, it has to structure all this, it has to document all this. This planning of dividend payment to the shareholders is nothing but the dividend policy. So dividend policy is a policy a company uses to plan, to structure its dividend payment to the shareholders. Is this clear, students? What is dividend policy? Yes.
Yes, ma'am.
Next, what are the factors affecting dividend policy? Obviously, when the management of the company or finance manager or the finance team has to decide on the dividend policy, like what should be the dividend given, should the dividend be given or not, at what intervals it should be given, okay, at what rate it should be given. So while making this policy, there are different factors that are going to affect the policy, that are going to, going to affect the dividend policy that is going to be made by the company. So first is contractual restriction. See, students, what happens is usually in banks, when you go to take a loan, okay, they just don't give you loan like, like this only. The banks had certain terms and conditions which you have to fulfill, okay, in order to take the loan. If those terms and conditions are fulfilled, then only the bank will give you the loan. So that is nothing but contractual restrictions will be there. Similarly, if you put in this situation, the lenders, like the equity shareholders, what they will do is they will put certain, when the shareholders are investing, students, in the company and the shareholders will be having certain contractual restrictions, certain obligations which has to be fulfilled. This is done in order to protect the interest when the firm is experiencing low liquidity and profitability. See, it is not possible every time to give dividend to the shareholders. Suppose if the company is making lower profits, then what will happen? Dividend will not be paid to the shareholders. So there will be contractual restrictions stating or made by the company stating that the profits will be given, the dividend will be shared with the shareholders only when there is profit. Okay, or only when there is excess profit. So contractual restriction will affect the dividend policy, because every lender or investor will invest in a company based on terms and conditions, based on certain obligations, based on certain restrictions. So to cater to those restrictions, these that may affect the dividend policy. Next is profit rate and stability of earnings. See, students, obviously, if the profit rate is lower, even if the company has made certain dividend policy, if the profit rate is lower, will it be able to pay better dividends to the shareholders? No. So this is one of the most important factor which is going to affect the dividend policy, because dividend is paid out of profits. Dividend is paid out of earnings. So if the earnings is stable, the firm will be in better position to, pay more percentage of dividends. But if the profit rate is not stable, it keeps on fluctuating, then the management will, or the finance manager will not be in position to prepare a dividend policy, because it itself doesn't know like whether it will make profit, not make profit. So obviously this factor is a important factor which is going to affect the dividend policy. If there is stability of earnings, yes, they can predict the future earnings. They can, easily mention what is the rate of dividend, or prepare a dividend policy which is unaffected. But if the profits on earnings are not stable, then obviously this factor is going to affect the dividend policy. Next is inflation. Now inflation is a, as you know, it is a state of economy where the prices of goods keep on increasing. Correct. Now inflation is a factor which is going to influence the dividend policy. Now, reason I'll tell you, students. Now, in inflation, what happens? The price or cost of the goods increases. Now, suppose if the company wants to replace its assets, okay, because if the assets have become outdated, okay, so the company wants to replace the assets. Now since it is an inflation, can they think of replacing the asset? No, because their earnings, because what happens is price is going high, and depreciation on that existing asset which they are planning to replace will also be not able to meet the cost of the new asset. So what they have to depend on their retained earnings. Now, if they want to replace an asset, they have to depend on their retained earnings. Now, from earnings, you pay off the dividend. Correct. So again, what happens? Earnings is getting utilized to purchase the new asset. Your dividend has to be paid out of earnings. So again, this is a factor which is going to affect the dividend policy. Next, types of dividend policy. You have stable dividend policy, regular dividend policy, irregular dividend policy, and no dividend policy. Now, suppose if the company is having a stable dividend policy, what does that mean? In this type of policy, steady and predictable dividend payments are made each year, which is what most investors see. Students, if I am investing in a company, I will always want that I should get a stable dividend, means fixed dividend, constant dividend I should get. Okay, so this is what most investors look into while investing into company. So if the company is opting for stable dividend policy, means the company is going to make dividend payment which is going to be constant, stable every year. Now what is regular dividend policy? Payment of dividend at a usual rate is termed as regular dividend. The investors such as retired person, widows, and other economically weaker person prefer to get regular dividends. Regular dividends means, suppose every year, every month, or every 6 months, if a regular amount of dividend at a usual rate is being given regularly. Okay, it is called as regular dividend policy. So it is basically required by investors who are retired person, because they want a fixed source of income, and dividend is nothing but the income to the shareholders, to the investors. Next is irregular dividend policy, where dividend is not paid regularly. Means it will not be paid every month or half yearly or 1 yearly, depending on the dividend policy. It is irregular. Suppose they get this year, they may not get next year. They may get after 2 years. So it is irregular. So it can be due to many reasons. The irregular dividend policy may, be planned by the management. The reason number one is liquidity crisis in the company, unpredictable future income. There may be no profitability or success in the company. So with these reasons, the company may opt for irregular dividend policy. Next, no dividend policy means where no dividend is paid to the shareholders, where the company may decide to keep the entire earnings as retained earnings or to meet its working capital requirement. See, students, there are various companies who do not pay dividend at all. Why? Because they have opted for no dividend policy, where they want that whatever earnings they are earning every year, they want to keep it in their savings. Retained earnings is nothing but savings kept aside to meet certain other obligations in future, uncertain obligations in future. So no dividend policy means even if the company is making profit, the company will not pay the dividend to the shareholders and will keep the entire earnings as retained earnings, okay, as a savings, or will use it for working capital requirement. So these are the different types of dividend policy of the company. Now, under stable dividend policy, students, there are different types of policy like stable and constant payout policy, constant dividend per share, or stable plus extra dividend. So these are the sub policies under constant under stable dividend policies. So when I say stable or constant payout, that is nothing but fixed percentage. The company will plan to give a fixed percentage of dividend on the earnings that is made every year. When I say constant dividend per share, it means what happens here is the companies will pay the fixed dividend irrespective in subject to the number of shares the investors is holding. When I say stable plus extra dividend, here what will happen, some companies follow a policy of paying constant low dividend per share plus an extra dividend in only those years where the company is making maximum profits. So there are three types of subdivisions under stable dividend policy. So these are the different types of dividend policy. So thank you so much, students. By this, we have completed the theory part relating to module number 6. In our next lecture, we will be seeing how to determine EPIT and EPS analysis and leverages. So thank you so much, students. We are done for the session